Warren Buffett opened his first investment firm when he was 25 years old. His investment group, which he named Buffett Partnership, was active from 1957 to 1969, during which time Buffett earned an annualized return of 29.5%. What's even more fascinating about Warren Buffett's investment strategy is its straightforwardness. According to Buffett, you don't have to be a rocket scientist to earn these kinds of returns on your investments. Investing is not a contest in which the person with the higher IQ wins out over another player. Instead, logic and reason are crucial. Therefore, the secret to generating significant returns is to have a level head. Stick to the basic techniques and not give up when the going gets rough. Welcome to Tech Tank Titans, and for today's video, we'll be giving you Buffett's investing rules that he has utilized to generate such great returns. Make sure to watch till the end because we're quite sure that you'll greatly improve your long-term return of investment. But before going on, please give this video a like and subscribe to stay updated for more of our future content. Now without further ado, let's begin. So this was a principle that Warren Buffett picked up when he first read the best investing books. Graham, who would go on to guide Buffett, authored The Intelligent Investor. One of the guidelines presented in the book was relatively easy to understand. The rule convinced Buffett that stock ownership represents a stake in a company and that, in the long run, a company's stock price will reflect the firm's success. To prepare for the future, you should seek the most profitable companies. Once they have established a solid reputation among their target market, they can forgo maintaining a complex guy stock. The success of their company is an indicator of your financial success. Most of the news you read is unnecessary, a controversial statement coming from Buffett. The truth is, when it comes to investment, YouTubers, websites, and news shows like CNBC, they are all compensated to attract as many viewers as possible. What then do they produce? As much drama or tension as they can muster, as much news as necessary to attract those viewers and increase their revenue. You can safely ignore 95% of it and focus on the 5% that actually matters. Because of all the talk about the market, the economy, interest rates, stock price behavior, etc., stockholders are often led astray by their fellow stockholders' unpredictable and often irrational actions, as Buffett puts it. Some investors believe that it is crucial to not only hear what the pundits have to say, but also to take their advice perhaps. Ignore the experts and the bulk of the media and focus instead on the essentials we have outlined here. In case you haven't been taught this already, compound interest is a strong tool that allows dividends and capital gains to rise like a snowball when allowed to accumulate over time. But if you trade stocks frequently instead of allowing compound interest to do its thing, you lose out on a lot of potential gains, exactly like the blue line. The progression of time is viewed as crucial in the financial markets. The key to investing is to hold onto equities for as long as possible, which is why Buffett has held onto Coca-Cola, Wells Fargo, and American Express for almost 25 years. As the great Philip Fisher once said, "The moment to sell is practically never, in the case of common stock, if the transaction was made with due diligence." The beautiful thing about investing is that we don't have to figure it out on our own. Even Warren Buffett has spent his whole investing career picking the brains of his peers. Benjamin Graham was his early investment guide and mentor. As he matured, he relied on Charlie Munger to confirm his rational thoughts. And fortunately, we may also learn from and embrace the wisdom of great investors. There is no mistaking Warren Buffett's as his stock purchases and whole portfolio are open books. We also hear from Charlie Munger and Ray Dalio, both frequent guests on CNBC. It's crucial, though, that we take the advice of those we already know and respect. And it's best to listen to no one, but those you know and trust. Educating yourself about the firm you're investing in is a no-brainer, but unfortunately, only some individuals actually do it. If we took at Warren Buffett's holdings, many of the businesses he has invested in are quite uncomplicated. Take Coca-Cola, for example. They don't just sell soda anymore. They've also branched out into the food industry. Southwest Airlines is a commercial airline that operates as a for-profit enterprise. You can buy furniture at Furniture Mart. You may buy iPhones and other electronic devices at Apple. You should rarely follow Warren Buffett's lead and purchase stock before you have a firm grasp of the company. If you're interested in automobiles, research Ford, Toyota, and Tesla. For virtually any interest, plug in e-commerce platforms like Amazon and Alibaba. If you enjoy the online world, check out firms like Alphabet, which owns Google and YouTube. You should only invest in the kinds of companies whose stocks are available for purchase. With the current state of the market, this rule is more important than ever. One thing you need to know about the current market is that it has been a bull market for the past 11 years. Currently, stock prices have increased by more than 300%. Since the beginning of the year, everything has been growing and everyone is gaining money, leading to widespread arrogance about their stock market prowess. One obvious consequence is that people grow greedy as a result of their newfound assurance in their own investing abilities. Do you have any idea what this means for stock values at this point? Stock prices continue to rise as more and more people look to invest in them, making it more challenging to locate a good bargain. Buffett recognizes that now is the moment to be cautious and afraid with financial investments. He has $228 billion in liquid assets, including $214 billion in publicly traded stocks. With that cash on hand, he is taking a conservative approach in the current market. You could argue he's been frightened, but as soon as the stock market begins to panic, Warren Buffett's greed will kick in, and he'll buy up a lot of companies at a discount. When it comes to investing, if you break this rule, you can throw out all the others, and your strategy will still fail, no matter how great of a company you're buying into, how well run its management is, or how well you know its business. Its value is finite, and you should always make sure you're paying less than or equal to what the firm is actually worth. If you're interested in purchasing a Lamborghini, you can rest assured that it is an extremely high-quality vehicle. There's no denying that the car's development was a labor of love for its manufacturers, but the real question is whether or not the asking price is fair. Is $350,000 a fair price? Keep in mind that no vehicle has an unlimited value, and neither does a flash stock in a company. That is why even Warren Buffett acknowledges that no business is worth paying an endless sum for, no matter how fantastic it may be. You get what you paid for, so make sure to distinguish the two. It's necessary to understand how to determine an investment's intrinsic value before attempting to assess the worth of individual stocks. And in any case, we believe these rules are indeed important when it comes to financial investments. Know that when you buy a stock, you are purchasing a piece of a company, and that your success will be tied to the success of that company. The vast majority of what you hear on business news channels and from internet personalities is not news, but background noise. A stock is a purchase that is best held indefinitely. Never invest in a business that you know nothing about. Always wait for a stock's pricing to make sense before making a purchase, and be cautious when others are bullish and optimistic when they're pessimistic. If you stick to these 7 rules, you'll be ahead of the majority of investors. We hope you learned a lot from this video. And if you did, please don't hesitate to share your insights in the comment section below. And if you enjoyed this video, go ahead and give this video a thumbs up and might as well hit the subscribe and bell button to stay updated for more of our technology and stock market news for you. This is Tech Tank Titans. Thanks again for watching and we'll see you soon.